Yeah.
Okay, let's get going. Hi, everyone. Good afternoon or good morning, wherever you are. We're happy to continue our series to meet our new colleagues in the CEPR Trade and Regional Economics Group. Today we have Chenzi, who is affiliated with Stanford, but right now in Europe, and we'll talk about finance. So we'll shift focus a bit to the financial sector this time. I will have to excuse myself at about 20 minutes. For those who are not US based, this may be a sort of a new information, but we have a new federal holiday to commemorate the abolition of slavery and emancipation of previously enslaved people. Today, it was yesterday actually, June 19th, Juneteenth. So today is the federal holiday. So we have some events to go and to join. So Chenzi, with that takeaway, again, we've been pretty sort of informal. People are welcome to jump in and ask questions. We go about an hour, including that, and can stay over slightly more if there's a discussion. So take it away.
Thanks so much, Karim, for having me on the seminar series. And as Karim said, feel free, please, to interrupt me at any point with questions. And let me go ahead and share my screen and get into full screen. Okay, so I hope everyone can see that. And yeah, so this is a project that's joint with Carlos Burga and Adrian Matre, both at Princeton. And it's about a financing channel of gains from trade. So the broad motivation is to better understand the sources of the gains from trade and to provide a quantification of it. So one way that trade is a source of growth is that it reallocates factors in the economy. So this is a channel that we're all pretty familiar with in this audience, where when countries open up to trade, the traded sector grows. And so firms become bigger, and these bigger traded firms are also ones that tend to be more productive. Okay, this is a process that generates wealth. And in this paper, we kind of just want to ask what happens to this wealth. And so what we're going to argue is that we think that the wealth that's generated from trade can actually lead to the accumulation of factors, not just to factor reallocation, and that this is a different source of growth. Okay, and we think that this is relevant for a couple of reasons. So one is just that the classic estimated gains from trade from static factor reallocation are quantitatively very small. Even though the world is super open, what we estimate are very small gains. And for this audience, I know this is a little bit, you all know this very well. For finance audiences, it's a little more new. But the second reason that we think this is really important is that empirically, there's a strong relationship between trade and growth, just a correlation, which insofar as we think might have a sort of causal relationship, goes away after you control for domestic investment. So essentially, if there is that causal link between trade and growth, it seems to go through this channel of domestic factor accumulation. Okay, so we're going to trace out this factor accumulation and essentially argue that this is a source of dynamic gains that are going to impact both the traded sector and, importantly, the non-traded sector of the economy, which will give us both larger trade gains and also a causal link that might help to explain this Levine-Reynolds empirical puzzle. All right. So
can I?
Yes.
Yes. My reading of this literature relating trade with growth is that it typically relies on cross-country evidence, and typically the difficulty of attributing a causal channel has to do with the fact that, for instance, there are all sorts of industrial policies that could have effects on both. So there's some sort of omitted factor that could relate trade and growth and actually be the initial factor, and those industrial policies could also contain policies that support investment in particular industries. So how should we think about what should be, from a causal perspective, what we should think of as the initiating factor? Is this sort of trade coming out of the blue, or I'm just trying to think about like the variation that you're going to use to relate causally the two.
Yeah, okay. So in terms of this particular motivation, you're entirely right that that literature is based on cross-country correlations, and this paper in particular is very clear that they're not going to be estimating really anything that has exogenous sort of variation. In our setting, though, I think I will get to that in a couple of slides, and hopefully that will become clear exactly how we're generating a change in trade barriers that will induce more trade. Yeah. Okay. So specifically, the first part of the paper is whether there is trade-induced investment, and this is a question that we want to answer in an empirically causal way. And then the second part is to basically to quantify how much growth this will generate. And this is very much a work in progress. So today we're going to focus on the first part, and we don't have an answer to the second part yet. All right. So the context that we're going to use to study this first question is a free trade agreement that was signed between Peru and China in 2008. Okay, so what we're using is the fact that both of these countries were part of the WTO, and so their import tariffs ex ante were those that were decided when they were deciding which tariffs to impose on all of their trade partners. Okay. The trade agreement, it's between these two countries, then eliminates those tariffs. Okay, and so broadly speaking, if you think of a firm profit function, we're thinking that this is a reduction in trade costs that's going to make exports from Peru more profitable, and imports to Peru from China cheaper. Okay, so there's also an element of import competition that's going to matter for domestic sales. At the moment, we don't have that data to deal with it empirically, but eventually in our quantification, we will want to we will be allowing for that margin as well. Okay, so basically we have this free trade agreement. It's going to lower the tariffs across goods, and that this is going to differentially impact Peru-China trade as opposed to trade with all other countries. Okay. So just to give you a little bit more context on the trade agreement itself, if we look first at Peru's exports, you do see that quantitatively this was an important agreement. Okay, so but we plot first the overall growth in exports to the rest of the world relative to China in the dotted light blue line, and then the total exports to China from Peru in the dark blue line. And as you can see, after the free trade agreement, the relative growth of exports to China is much, much bigger than the relative growth to the rest of the world. Okay, so that's just in the aggregate, this appeared to have mattered. Just to give you a bit more of a sense of the underlying variation, what I'm showing you here is the top 12 products that Peru exports. Okay, so as you would expect, these are very much commodities and low skill manufactured goods that have actually quite a range of tariffs ex ante, and they are roughly the way you would think the tariffs to China would go, in the sense of China was not taxing raw materials that it would need for its own growth. It was taxing, for instance, cotton t-shirts that it itself produced a lot of. Okay, so these are the tariffs ex ante, which then the free trade agreement would bring down to zero. Okay, so the overall underlying variation across products is the following. Okay, so you do see that the number of products that did not have any tariffs ex ante, and so there's no change in the tariff rate after the free trade agreement. And then there's a long tail of products that were heavily taxed that now have a tax rate of 0. Okay, so that's the very micro underlying variation. Now, what we'll do is essentially go through the following empirical steps, where we first identify a first stage of sorts, where we show that the free trade agreement has a direct impact on exports by firms. So firms that were ex ante exporting more of the goods that had the bigger tax break are going to export more afterwards. So this is a direct, this is what we would expect to see. And in fact, we do see it. Ultimately, we would want to look at firm profits. At the moment, we don't have that data, but eventually that's what we would want to link it to. But as a first stage, we do see that the change in the trade cost leads to a change in trade volumes.
Yeah, sorry. So just to clarify, you describe on the second line of this slide of the FTA being a trade cost shock. So why are you focusing just on the cost shock and not on the demand shock as well? Particularly the fact that you actually see an increase in exports. It sounded to me before as if it was both the demand shock and the cost shock at the same time. Or am I not understanding something?
Oh, you mean a demand shock from the perspective of Peruvian firms?
Peruvian firms now having the ability to be more successful selling to China because they import tariff. I mean, the FTA was reducing tariffs both ways, right?
Yes, yes.
So that's both the demand shock and a cost shock for the Peruvian firms.
Well, I think of it as it's a demand shock because relative prices have gone down.
A cost shock, you mean? I'm confused why you're focusing just on the perspective of Peruvian firms being importers and not also on the perspective of Peruvian firms being exporters to China and now having.
So we are focused. So in all the empirical exercises I'll show you today, we focus on Peruvian firm export sales because that's the data that we have currently. But we will. So I didn't show this earlier, but. What we ultimately have in mind is what matters. So for firm I, sorry, this is an appendix slide, but for firm I, what ultimately matters is a change in their profits. So we care about Peruvian firm profitability, whether that comes from domestic exports, which is the part that we trace out today because of the data that we have, or because of Peruvian imports, which would help with their cost function. And as I very quickly mentioned, but didn't go into the details of, we also know that there's an element of import competition that will likely matter for Peruvian domestic sales. So this overall cost function is the one that we have in mind. Today, we're going to focus on this component that comes from the export tariffs to China. Again, because of the state of the data we have today. Yeah. All right. So
quick question, Chenzi.
Yes.
First, I think at some point, kind of related to Isabella's question, you said China already had low tariffs because Peru is a commodity exporter and China is a consumer of those products. So it was already taxing them at a lower rate, if I understood correctly.
So yes, sorry.
But of course, you can use whatever variation there is. There may still be an increased market access to China. Is that right?
Right. So yes, so there are a large number of goods like this copper ore where there's no change in the tax rate. So we wouldn't expect there to be any change in sales in the way that we've written it down as a pure function of the change in the tax rate. Yeah. But there is still this, large, quite big distribution of products where there is a change in the tariff.
So another thing to add before I go, and I'll watch the rest from YouTube. I mean, as you know, in that literature, whether you're talking about steady state growth rate versus transition it's an important conceptual difference, and there's typically, like, we don't think that trade makes a difference in growth rates, but rather takes us to a higher level. So are you thinking about transitional trade-induced investment? It
Yeah,
would be good,
there
like
will be an
motivating in how you think about the relation to that literature and the dynamics.
yeah. Thanks for that question. And in the future we'll try to be much more precise about it. What you'll see in the empirics is that it is, there is this in the short run, just this change in the transition, and then the effects do seem to plateau off. Yeah. Okay. All right. So so first we want to show that there's an effect on total trade, and then where the paper really hinges is to show that when these firms export more and presumably save more and generate more profits, there's an indirect benefit to the financial sector. Okay. And then in the final stage, this part that I mentioned at the very beginning of the talk, there's a reinvestment by the financial sector into domestic firms, which are in both the traded sector of the economy and non-traded sector economy. So, we expect that when there's a change in the profitability of the traded sector, that would grow. And in fact, that's what we see here. But what we're going to argue is that there's also this quite quantitatively important element of growth in the non-traded sector, and that comes through the financial savings. Okay, so just as a preview, we do see this growth in product exports. We see growth in the banking sector that's linked to the firms that grow from trade. And finally, we see this reinvestment that firms are both in the traded and the non-traded sectors are able to grow due to obtaining loans from the banks that grew from their own indirect access to the traded sector. Okay. Right now, we don't have the data on firm balance sheets, so we won't have real firm outcomes, but we will show you that firms are able to borrow more, which is a pretty good proxy for firm size. Okay.
Chenzi,
yes.
Sorry if I'm going, I'm just trying to make sure I understand the setting. So there is a world in which we can think there are, the firms that are exporters or importers directly, they get this demand shock or cost shock, depending on which angle you want to focus on, or both. And then through either localized spillovers, these firms grow, their employees go more and buy food from restaurants, or through input-output linkages that now they're able to pay for whatever, cleaning ladies or something. They will basically split. There's either a localized or an input-output way to share these demand shocks, let's say, that they're getting. And that would lead to firms having whatever better collaterals and being able to invest themselves in their own business. So how are you planning to isolate that this is something that is about the banks, as opposed to the banks stay the same? There's nothing that happens to the banks themselves. It's the firms that are in a better position to borrow.
Yeah, so I will have a better answer for that when I show you the empirical specification, but we will try to be very clear about exactly what the identifying assumptions are and the way that we deal with threats to identification that might, for instance, come from changes in local demand shocks that are perhaps unobserved, or firm characteristics that change over time. Yeah, okay. So I will skip this in the interest of time. All right, the data we have are these sets of admin data sets that we're able to link, where first we see the full customs of firm I exports by product to destinations. We also see the credit registry of the universe of bank loans matched to individual firms. We see bank balance sheets. So these are the characteristics of the banks that we're going to be able to track. And at the moment, we have a limited set of firm characteristics and outcomes, but when we get access to the firm balance sheets, we'll have, this will be much more fleshed out. So currently what we're able to see are loans at the firm level that comes from the bank balance sheets, unfortunately. And then what we'll use is a survey called the EEA, which is a large survey for the bigger firms in the economy. And this covers about 60% of the total credit and 50% of the total exports. Okay. And the way that we currently use the EEA is simply to get better indications of firm industry. And that will help us to distinguish a bit better between not only non-exporters, but also firms that are, really non-traded. So firms that are, not even upstream from a direct exporter. Eventually, we'll not be using this at all. So this is really just a placeholder currently to make our point about the non-traded versus the traded sectors. Okay. All right, so we have a number of measurements of exposure to the tariff cut. The most direct is the change in the tariff itself, okay, which varies by product and destination, where it's set to the initial tariff rate if the destination is China after 2009, and it's 0 for everything else, okay? Now, for a given exporter that has a direct exposure to the change in the tariff, we'll have the following firm level exposure, which is simply the weighted average of the individual product level changes in tariffs, weighted by the importance of a given product to that firm. Okay, so this is, I think, fairly standard. What we're saying is we just look at how important different products are, and then we weight the shock to each product. The next aggregation is really where we're going to argue there's causality. And I think this goes back to your question, Isabel, about, how do we know it's really something about the banks? So here, the bank level exposures are a very similar aggregation, where we're going to say that these individual firm level shocks are aggregated by their importance to a given bank. Okay, so this follows the exact same shift share sort of philosophy, but on the next slide, I'll be very clear about what our identification requirements are for this setup. Okay, so that's, this is the linchpin of the paper of, okay, this bank exposure is based on the individual exposures of thousands of firms. In the final step of the paper, where we care about this reinvestment, we also have a firm's indirect exposure. So these are firms that are non-exporters or not in the non-traded sector. And the only way that they have exposure to the tariff cut is through the banks that they're borrowing from. All right. So for any bank level relationship where we have some bank level outcome that we're regressing on this bank level exposure to the tariff cut, where this bank level exposure to tariff cut is this aggregation, we need the following to be true, right? So we're just rewriting the exogeneity condition with breaking out the particular shocks in the shares. Okay. The nice thing about this, for all of you who are familiar with the Bruce-Nicole and Geravel paper, is that we have actually a much looser set of requirements than what is typically the case when it comes to if you were just to write it out without the aggregation, right? So we can have that firms are systematically different. So we don't need this particular expectation to be 0. And we can also allow firms and banks to sort. So we don't need these the set of expectations to be 0 either. The specific assumption that we need is that the firm level tariff shocks, so these individual TCIs, okay, that appear here, are orthogonal to the characteristics of these banks. So whatever is important for this outcome, that's captured by this error term. on average. Since all of our estimations will be using a different from this policy shock, we'll need it to be the case after 2008 relative to before, okay? So to be super concrete about that, I'll give you some specific examples of threats identification, just so that you have some intuition for the types of issues we would be worried about. Okay, so if it is the case, so first of all, what you should be thinking about is, all right, you need something else to be happening, but it should coincide with the tariff cut itself. And so in 2008, obviously, we do have the global financial crisis happening. So maybe one example of a threat to identification is that there were a certain set of banks that were less exposed to the US in general in 2008. And these banks were able to grow relatively more after the financial crisis. And so that's the reason that they're growing. And these banks are also happen to be lending a lot to firms that were exporting in these high tariff cut industry or products. Okay, so that's a sort of correlation that you would need statistically in order to have any sort of to have these positive effects, and this would be what needs to be going on in the background for it to be a compounder. Okay, so more generally, banks that lend to firms that are booming for other reasons after 2008, this could be more generally another threat to identification, and specifically with respect to the policy itself, it could be that the free trade agreement comes with particular investment credits that we're not able to perfectly observe, and so certain banks are able to differentially benefit from those, and those are the banks that are also lending more to firms that are more exposed to the tariff cut. Okay, so that's the sort of realm of threats that we need to think about. Okay, so the way we deal with that is all of these concerns is pretty standard. So first, we verify that there are no pre-trends in the outcome. So any bank level sort of characteristic that might make a bank bigger in general will not be showing up. Is not a concern for us in this case. And then we have, as many different measures for firm level exposures and their correlations with characteristics. So, how much of a foreign liabilities they have, how much exports, market specialization they have in China. We can think of specific product demand booms in China. We can look at the size, geographic location, foreign ownership indicators. And in general, what we care about is whether there is any correlation at all between banks that have a high level of exposure and these other characteristics. Isabella?
Sorry, just for me to understand a bit the empirical context. So how many banks are there in Peru at that time? Would you mind giving us a bit more idea about like the structure?
Yeah.
Because in many countries there are like 3 firms that are like 90% of the market. So like 3 banks.
So there are about 50 banks. But what's important is that each bank, the shocks that come for the shocks that we calculate for each bank come from individual firms, and there are thousands of exporting firms. Okay, so there's quite a large.
What I'm asking is, are there what is the market concentration? Like, for instance, in Costa Rica, there are like 150 banks, but 3 banks are 90% of the market. So I'm just trying to understand how much of the market is concentrated in a handful of banks versus, so not the total number, but the concentration.
Yeah, off the top of my head, I imagine, so I don't have the HHI for the banking industry. I'll look that up. It has a size distribution that's very similar to the firm size distribution in most countries, which does have a skew in it. Like there are some banks that are very big, but that in and of itself, I don't see how that would matter in the sense of this is still a bank level characteristic. So we can say, all right, what is the relative market share of a particular bank? So we can look at that particular characteristic, which, by the way, will, I think, be fairly correlated with this one, since
But
Those
won't
are going to
you be
be
running regressions at the bank level? Am I
we
misunderstanding?
will be running regressions at the bank
But
level,
then
but we'll also
outliers are
have
really
bank
important, right?
we'll have bank fixed effects, and we'll also, I mean, okay, so we have done a robustness check where we drop individual banks one by one. So there's no individual bank that is driving all of our results. We have it on our to-do list to drop deciles of banks. So we'll drop the top 5 and rotate through those and check for that. So we have there's no individual bank that's driving everything, but there's a more general version of this that we can do. Yeah.
Thank you very much.
Yeah.
Can I ask a question?
Okay. Yes, of course.
So sorry, I'm a little bit slow today, so I might have missed a little bit what's going on here. So there is this shock, this cost shock, and then in response to that cost shock, some firms get also a positive credit shock.
No, sorry. Yes, there is a trade cost shock. There's a change in trade costs.
Yeah.
And those firms will grow. And this will impact banks. This will impact their banks.
All right. So, and then they get more credit. No.
Well, so we're going to look at what happens to the banks. And then we will.
Banks.
Yes.
So, but how should I think about it? I think somebody already asked it, but I'm a little bit puzzled by, the timing of this thing and how does it happen? Like, just because, I trust your details on the bank level specialization and all of that. I just want to understand what's the story a little bit better. Maybe I missed it a little bit. I'm slow, sorry.
Oh, not at all. Here, how about okay. So the structure of the results that I show you basically follow the logical progression of what we think happens. So first, because of the change in trade costs, we have exports growth. Firms. Then the banks lend to those firms are going to grow. And we are going to dig into precisely why that's the case. We haven't done that yet, but there are a couple of reasons we think this is very likely the case. One is that as firms become more profitable, their non-performing loans will decrease, and this will make banks more profitable, and it will free up more capital for lending. So that's one reason the banking sector may grow when their customers do better. Another reason may be changing in risk weights, capital risk weights. So firms grow and they become less risky, and so lending to them is less costly from a capital perspective. Okay, so there are a number of possibilities here, and that's a place where we need to dig into it a little more to tell you a very specific story.
Can I interrupt you here? Sorry, because that's the part that I'm a little bit missing. Why isn't that the case that they just increased their lending to these firms and it's just profitable to have more lendings? Like why
these firms are growing,
performing teams, and so I understand these firms growing. They won't help the bank growing.
The banks are growing. Yeah, the banks are growing.
Yeah. So, but why does it have to be the case that it goes through non-performing loans, or I don't know? Isn't that just the case that these firms are doing better? They just do more volumes on transactions, and then they get more credit, and that's profitable for the bank.
So what yes. So these firms are growing. That's good, and the banks are benefiting from that. And we're gonna show that in what we think is a causal way. If it's obvious to you, then that's great. I don't think that it is particularly obvious, because you could also imagine that firms grow, they demand more credit, and this crowds out lending by banks more generally. The bank itself does not necessarily need to grow, right? It's not obvious that banks will grow just because their firms are doing better, or some of their customers are doing better.
Sorry, can I make a question? Chenzi?
Of course.
Hi, my name is Francesco Briti. So I I also would like to see a regression on loans to the exporting bank, to the exporting firms, even if it is a correlation.
We are going to get there, and it
All
will not be a
right.
correlation.
Yes, even if it is a correlation, it suggests that that is the channel. Obviously, if it's not only a correlation, it's better. Another thing is, what about commodity prices? Are commodity prices going up differentially at the threshold, the time threshold, or not? This is a doubt we should rule out at the beginning, because the benefit from banks could come from prices and not from volumes. And third, I suppose that banks, if banks benefit from the free trade agreement, which relax not only exports, but also trade costs to imports, there should be no relevant growth of imports, some sort of import substitution that is affecting negatively domestic Peruvian firms. You understand what I mean?
Okay.
No.
So I think the best answer to your question is the following appendix slide that I pulled up earlier, which is, it doesn't really matter to us whether the effect comes from prices or quantities. What we care about is profits. And it could be that, there is a change in, we do think there's a change in prices that's going to come from the tariff change. There may be another change in the commodity prices. If we think that as a confound, if you're worried that that's a confound, there are ways for us to deal with that, which I can go into more detail if you want. But more generally speaking, prices or quantities doesn't really matter. What matters is profits. In terms of import competition, yes, there is a change in Peru's import tariffs from China as well. And this change in domestic sales by a given firm is precisely what might be affected by the import competition channel, right? Where Chinese imports are going to compete with Peruvian domestic sales. And this change in sales may not be positive. It may be negative. The firm may become less profitable in its domestic sales. And so we do allow for that. And that is, we do care about that. And so far as it matters for identification today, there needs to be a strong correlation at the product level between the change in the tariff of Peruvian imports and Chinese imports for this to confound what we're doing today. And that's not the case. So as a sort of first pass, we don't think that this part of the profit function is going to be a big problem. But eventually, once we have the balance sheets, we'll be able to estimate this correctly and be very specific about how that matters. Yeah.
Okay, I agree with you. Just a quick reply. I would also look at aggregate price levels by commodity because of the policy implications of your paper. So you have to make a free trade agreement to liberalize and spur growth, but you have to be lucky enough to take the period of price increases of commodities or whatever exporting products you have. Or the policy implication could be make free trade agreements, whatever the prices are. Understand what I mean?
We can definitely look more into that.
Yeah.
Okay, so first set of results are on exports growth, which is at the firm level. And here, we don't even need to argue that this is a exogenous shock to a firm per se. We do think that's the case, but broadly, all we're going to say is, hey, firms that experience more of a tariff cut also had more exports. Okay, and this is because, and this is really sort of that first stage of we see a change in export sales in that firm profit function. Okay, we're going to include a number of fixed effects, which include, for instance, the firm size quartile year fixed effects that allow the fact that some firms are bigger and they may just be differentially growing, and being a bigger firm will likely be more correlated with the tariff cut just because they're exporting more things. And this means that we're not just picking up on size differences in growth. We'll also use within firm variation okay, which broadly is going to deal with a correlation between any firm characteristic and the tariff. So, if you have in mind a political economy story where firms that know they would really benefit from a free trade agreement and know that they're going to really have a lot of sales growth in the future are going to lobby for this, well, that's probably not what's going to happen, because that's not really what's that will at least in part be picked up by this fixed effect here. Okay, and so just again thinking of this as more of a first stage, what we see is that the total volume of exports, okay, from a given firm I to China in the post period is growing. Okay, so this average is that it's about 7% more exports after the tariff cut relative to before, in comparison to total exports, which grow about 3%. Okay, so if we were just to look at the relative shares of exports to China, you would see that there's a large increase in the relative shares after the trade cost shock. Okay, so this is precisely what you would expect if this tariff cut actually mattered. Okay, so now let me turn to the
Chenzi?
banking sector growth. Yes, hi.
Quick question: is there any way you can test whether this is not only substitution away from the rest of the world and directed to China, that there's some sort of aggregate increase? I mean, in the aggregate data that you were showing, it's, if you were just roughly extrapolating from the pre-trend, it seemed that the rest of the world was tanking and China was, so it wasn't clear whether the average amount of exports in the economy was still growing. Maybe you could do something at the industry level to test that. I don't know if you've done it.
Yeah, no, that's a good point, and we haven't done it. But yeah, how much is so right? So what we kind of think, just looking at this regression, and we should dig into it more, is that goods are, the same firm is diverting some products to China where it before would have been exporting to them to some other destination. But how much of it is diversion versus trade creation? We haven't done anything along that margin. Yeah. But if you have thoughts, we could talk about it a bit more. Okay. All right. So let's turn to the banking sector growth, which I see is a sticky point. All right. So the estimation that we have is the following, where the left-hand side to begin with is the loans by a given bank. So a given bank in a given location. So think of this as a city in a given year T. And we care about how that changes with respect to the bank level exposure to the tariff cut. All right. Now, the endogeneity concern in this specification is precisely the one I walked through earlier, but rewording slightly, that banks lending to firms with high TCI and therefore have high TCB are growing after 2008 for reasons other than the tariff, the free trade agreement. Okay, so for some unobserved reason, they're growing, and it's just correlated with this measure. All right. What we're going to do to help deal with some of these concerns is that first, we're going to include bank city location fixed effect, okay? So this restricts our identifying variation to being between banks and cities that are borrowing from each other the entire time period. Okay, so it's not simply that some banks are really good at identifying places that are booming. And so they're going to begin lending to those places more. Okay, so we really do need that. These are banks and cities that are already have a established relationship. This also rules out a new bank entering, right? So a new bank that enters that, a Chinese bank that has very high exposure to the tariff cut, that suddenly knows exactly where all the exporting firms are and lending to it for those other reasons, that will be eliminated with this fixed effect as well. We're also going to include.
Sorry, Can I ask you about this? Sorry, I'm very curious.
Yes.
So you have bank branches? Or those
we have, yes, we have, so the central bank data has a disaggregated version that tells you for every city how much a bank lends on aggregate to the firms in that city in a given year.
So let's say when I think about this data, usually, like at least in the Portuguese case that I'm familiar with, in the CRC, in the banking level credit registry, you know that there is bank, I don't know, Santander or Deutsche Bank, but then so you're telling me that that the banking group lends to certain firms, but how much of that banking group lends in a specific city. So that's how you
it's
can.
It's two separate data sets. So there's the credit registry. There's all right.
Okay,
so we don't actually do any aggregate. Got it. Okay.
Okay, thank you.
Yep, you're welcome. So then we are also with this data set able to include city location year fixed effects, which is going to absorb city level demand shocks. So it's not simply that some cities are growing more than others, and those cities are ones that borrow from banks with high exposure. Now here we are able to include a lot of the bank level characteristics that may be concerning for this story, and interact them with year fixed effects and eliminate those as reasons for certain banks growing. So for instance, if we think foreign liability exposure is a good proxy for a bank's exposure to the US and to the financial crisis, then banks that have very low exposure, well, we're going to control for that directly, and we're going to show that those banks, we're going to allow them to have differential shocks by year. Those aren't the banks that are, those banks growing more for those reasons aren't going to be driving our results. We can do the same with specialization in China. We can include very standard bank size quartile, fixed effects, whatever you can think of. Just to mention here, for instance, in the same way that we measure a bank's exposure to the tariff cut, we can also measure a bank's exposure to a commodity price change. You can imagine the commodity price change, how much that impacts a given firm, and we can aggregate that up to a bank level as well, and we can directly control for that. Okay, so if you feel that, we might feel that a commodity price shock is actually a confounder, and this is not the channel that we're working through with the tariff cut, then that's something that we can directly observe and deal with. All right. So what we see is that is the following picture on average, which is that there is no pre-trend in terms of the differential lending between banks and in a given location, and that after the tariff cut, these banks that are in, these banks that have higher exposure to the tariff cut are lending more, okay, across cities. Now I'm just going to walk you through all the controls that we have. We have, for instance, the China specialization measure by bank. This makes pretty much no difference. Isabella mentioned the size of a bank. We can include, for instance, a bank market share, although we do have their size quartile. We have foreign liabilities share, and that's a continuous measure that makes no difference. We have a foreign ownership indicator. For instance, Citigroup is a foreign bank in that respect. That makes no difference. And we can include all of these controls. So really none of these characteristics that we might think would be experiencing differential shocks around 2008 are driving any of the overall pattern that we're seeing. And the overall pattern is that banks that are more exposed to this trade cost shock are also lending more. Okay, now what's actually going on at the bank level? Well, we then look at the bank level outcomes. Okay, so now we're no longer at the bank location and we're down to the aggregated bank balance sheets. And what we see is that banks that are more exposed have a higher ROA. So they're more profitable. For a given dollar soles of assets, they have higher returns. They also get bigger. Okay, so the size of their balance sheet is much bigger. And this is not just liabilities. This is actually capital. So the net worth of the bank is also growing. And all of these, in turn, allow it to then lend more. So this change, what's going on here, with the ROA, the assets, and the net worth, these are the elements of the balance sheet that we want to dig into to help to explain why these banks are lending more. But in the next set of regressions, I want to emphasize that we think of these effects as the firms that the banks are lending to are becoming more profitable. The banks are benefiting. This is not simply a response to credit demand. Okay. All right. So I've shown you that firms export more and that their banks grow. Now I'm going to show you this transmission of loans to the real economy, to both the traded sector and, importantly, the non-traded sector. All right. So the following regression is at the firm level. I think this was one that someone asked for earlier in terms of wanting to see borrowing. So these are loans for a given firm I, which we can index as being a traded firm or a non-traded firm by a given bank T. Okay, so we're just aggregating all the loans that a firm gets from a given bank in a given year. And again, the endogeneity concern is the same, that banks might be lending more to certain firms for reasons that don't have to do with the tariff cut itself. We're going to include these bank characteristics. We're also going to include firm year fixed effects. So this is the standard firm shock that's going to absorb credit demand. So if firms are just getting bigger and demanding more credit, that's going to be taken care of in this with this fixed effect. And we're also going to restrict our identifying variation to being within bank-firm relationships. Again, this deals with bank or firm entry, and it deals with selection of who to lend to. All right. So when we estimate this using the log specification, so this is just the long difference over time, on average, we have this 12% increase in lending by banks that are more exposed to the tariff cut. We can use our exports, our customs data to delineate firms between being non-exporters and exporters. And an exporter in this classification is a firm ever exports in the entire period that we have been. Okay, so it's a fairly, it's as demanding of a classification as we can, given the as we can create using the customs data. All right, and what's important here is that it's not just lending to exporters that's growing, it's also lending to non-exporters that's growing. Okay, now you'll notice, as we all know, that there are relatively fewer exporting firms in the economy. And you might have a question of like, all right, so in the aggregate though, once we take care of firm size and it may not matter that much, right? All right, so I'll show you those results in just a second. Okay, we also are able to use the EEA to categorize the industry of a firm specifically between tradable and non-tradable. And again, we have similar results of traded firms do have more credit, but non-traded firms as well. And this is coming from the fact that their banks were more exposed to the trade cost shock. Okay, we can estimate this using a midpoint growth measure instead. And that's the nice thing about this, is that we deal with entry and exit, and also we can do a much more precise decomposition. All right, so once we collapse it into two periods, we're simply running that one diff. And so, this we estimate the elasticities on these individual subsamples of all the firms, exporters, non-exporters. Again, the coefficients are economically large and statistically significant. We can do the same thing for the EEA's tradable versus non-tradables, where the distinguishing factor is that the non-tradables are truly sectors that we think are not even upstream of the exporting sector. And then what we can do is reweight these coefficients based on how important these types of firms are in the economy. So here we can calculate these weights of exporters versus non-exporters based on the share of lending that they received ex ante. And what you see is that, all right, the overall expansion in credits across all firms is this 30%. Whoops, apologies. Okay. But if we decompose it into the exporter share versus the non-exporter share, actually 92% of the magnitude of the impact of new lending by banks goes to non-exporters. So it's actually the more domestic part of the economy that's growing more from these bank expansion. It's a very similar story when we look at the EEA in terms of this tradable and non-tradable share. As you would expect, the non-traded sector is a smaller sector relative to the non-exporter sector, and so that's it takes up a slightly smaller share, but it's still the case that it's getting the majority of the credit. Okay, so this is the transmission of loans from an individual bank to firms that it's lending to. Okay, so this is looking at the bank direct exposure. All right, now in our final step, we're going to turn to firm level outcomes, and here we use the indirect measure of a firm's exposure. So these are no longer necessarily exporting firms that have a direct exposure to the tariff cut. These are firms that would only be exposed through their banks. And these are going to be firm level regressions. So today we have total loans. In the future, we expect to have more real outcomes at the firm level, for instance, overall size, employment, investment. We do expect all of those to be very correlated with firm credit because that's what we've learned about firms and financing. Okay. And the
Can I just make a very quick question? So I think when you move to other firm level outcomes, it would be interesting to see the average of non-performing loans among exporters. They should decrease after the FTA, and also among non-exporters. So this is even more interesting because if your story is the true one, as we tend to believe, this means that banks benefit from these successful exporters. They have more capital to lend, and they lend it also maybe more or less efficiently. There is a policy implication. Maybe you could reason on this non-performing loan default rates, average default rates.
Yes. So that's a great suggestion. We at this level of the analysis, this kind of goes back to what I was saying to Alessandro as well. We would like to know what's going on and precisely dig into the characteristics of these loans, and perhaps they are becoming safer for the banks, and that's why.
Do you have from the credit register whether a loan is deteriorated, performing or non-performing, an indicator?
Yes. Yes,
okay,
we have an indicator for non-performing loans.
Yeah, so okay, use that.
Yes, exactly. So that's generally digging into the channels of how it is that these banks are growing and benefiting.
Yeah. Okay.
So at the firm level, the endogeneity concern is, as we should be well familiar with now, that the firms are growing and are affected by exposure to a given bank for reasons other than the direct firm level, for reasons other than the bank's exposure to this tariff cut. Okay, we're going to include firm fixed effects, which will deal with differences in firm size, for instance, on average. We'll have firm characteristic, allow for firm characteristic shocks. Today, we will have the size quartile, because that's a characteristic that we can observe very easily. In the future, once we have, again, the firm balance sheets, we'll be able to expand this much more, okay? And this allows different, differential shocks to different types of banks. For instance, ones that are in certain industries relative to other industries. So it's not simply just an industry level demand shock, for instance, that's driving firm size growth. Now, at the firm level, we can't directly absorb firm demand shocks, because that's, that would be collinear. But we can include as a direct control the estimated fixed effects from the bank firm regression. So insofar as those fixed effects captured some of this unobserved demand shocks, we can bring those back in. All right. So in this final set of regressions, what I'm showing you is that for a given firm, their indirect exposure to the tariff shock leads to more borrowing, okay? And this is, we think, a pretty good proxy for the other real outcomes that we'll eventually be able to look at, like size and employment and investment. This is true for exporters. Sorry, this is true for all firms. This is true for non-exporters, okay? And this is true for the non-traded sector and the EEA more generally. Okay, and in this very last set of regressions, here we can include these firm year estimated fixed effects, okay? And you'll see that the coefficient between these two columns doesn't change that much. There is an element where maybe there are some unobserved shocks to firms that might impact how much lending they're getting, but it doesn't explain all of the effect here, all right? So even at the firm level, firms that are not in any way exposed directly to the trade cost shock, they're benefiting, and they're benefiting through the channel of their banks growing. Okay. All right. And then for a full disclosure, here is the full time series of the diff and diff. At the moment, because we lack so much of the firm characteristics, we do acknowledge that there are probably unobserved firm level shocks that are happening in the background. But once we have the firm balance sheets, we'll be able to deal with those concerns much more. All right, so just as a recap, we use the setting of Peru's free trade agreement with China as a setting for a trade cost shock, which exogenously changed trade costs and therefore raised trade volumes. And we measure this exposure and argue that we're able to causally identify the impact of this free trade agreement on sectors directly exporting, banks indirectly exposed, and finally, the domestic economy that is indirectly exposed and only exposed through their banks. Okay, and we find this large growth in financial capital and from borrowing, which we're pretty confident will translate into real outcomes. Okay, so the paper so far is really trying to identify and trace out this channel of factor accumulation in the domestic economy following a trade expansion. And going back to questions that were raised earlier, empirically, we will be looking at the import side, the import competition, and of course, bringing in real firm outcomes, and then theoretically tying the bank collateral constraints in lending to this trade expansion to quantify the magnitudes of the change in the policy. So thank you very much for your attention.